Welcome to the Deep Dive, the place where we turn massive stacks of research into actionable, high-impact knowledge.
Glad to be here.
Today, we're strapping in for quite an exhaustive deep dive. We're looking into the brutal, chaotic, and relentlessly demanding world of active trading. Specifically, we're focused on the blueprint for survival and longevity. We've drawn this from veteran market analyst Jason Alan Jankovsky's guide, Trading Rules That Work. The 28 essential lessons every trader must master.
Yeah, and look, if you've been around markets for even, 5 minutes, you've heard the basics, right? Cut your losses.
Let your profits run, the classic cliches.
Exactly. But just knowing those slogans, that doesn't really translate into making money consistently.
Yeah.
Jankovsky's real genius, I think, comes from his 20-plus years trading everything stocks, commodities, Forex.
A huge breadth of experience.
Right. And he distills the why and the how. How do you actually apply those rules consistently, especially when, fear or temptation hits you hard?
And the core idea, his central thesis, that's really where we need to start because it flies in the face of how most people approach this.
It really does.
Jankovsky basically says trading success is overwhelmingly behavioral. It's, 90% psychology and personal discipline?
90%.
Yeah.
And only 10% is knowing the actual rules or the system you're using.
That 90-10 split is just critical, isn't it?
It explains so much. It's why smart people can read every trading book, understand chart patterns perfectly.
Oh, yeah, they know the theory inside out.
And still blow up their accounts.
Yeah.
The market isn't really testing your IQ or how well you draw trend lines. It's testing your discipline when you're under pressure. Knowing the rules is the easy 10%. Consistently applying them. Sticking to Rule 7 after 3 losses in a row. That is the 90%.
And that breakdown in discipline, that emotional override, that's what turns someone who might even have a winning system on paper.
Yeah, a potentially good edge.
Into predictable prey, especially in a zero-sum game like trading. So our mission today isn't just listing these 28 rules.
No, that'd be too simple.
We want to dig deep, extract the psychological antidotes, the actual mechanical, actionable principles that can help you stay in the game long enough for your statistical edge, or whatever it is, to actually play out.
Building that blueprint for professional longevity, that's the goal.
Okay, let's lay the groundwork first. The foundation, which is all about treating this like a serious business. Not a hobby, definitely not a lottery ticket.
Essential starting point.
Rule number 1 seems almost too simple, but it's violated constantly. Know your game.
What exactly does he mean by a market's DNA? What specific stuff does a trader have to master?
Jankovsky is really emphatic about this. Trading isn't, one-size-fits-all skill. You're not just trading price in the abstract.
Right.
You're trading within a specific ecosystem. So when he talks about a market's DNA, he means its unique, measurable traits. Things like its liquidity profile, how volatile it typically is.
Who the big players are.
Exactly. Who are the dominant participants? And crucially, what are its common behavioral traps? Things that happen during specific trading sessions, for example. That immediately pushes back against that overconfidence bias, doesn't it?
Oh, absolutely.
The idea that, hey, I crushed it trading Apple earnings, so I'm ready to jump into the euro-dollar futures market during the London Open.
Totally different ballgame. The players are different. Their motivations are different. In Forex, you've got central banks, massive corporations hedging huge currency exposures. They move differently.
Slower, maybe, until news hits?
Often, yeah, until high-impact news breaks. Then compare that to, say, corn futures. There you got commercial hedgers, farmers reacting to weather forecasts, completely different dynamics.
So trying to force a strategy from one onto the other.
It's asking for trouble. Like trying to use a momentum strategy built for liquid Forex on some thin, illiquid, small-cap stock. You'll just get chopped up by the lack of flow.
And this ties into that really practical example he gives about market gaps. Can you walk us through that difference? It really highlights the unique DNA concept.
Yeah, it's a perfect illustration. Jankovsky found, through his own really rigorous backtesting, that gaps in S&P futures, the price difference between yesterday's close and today's open, they tend to fill. Meaning the price usually retraces back to cover that gap.
What was the percentage?
About 70% of the time, according to his work. So that tendency often becomes the basis for a mean reversion strategy. People try to fade the gap.
Makes sense statistically.
But here's the catch. If you take that exact same fade the gap approach and apply it blindly to, say, the USD currency pair,
it doesn't work.
You fail. Why? Because the institutional behavior in Forex is different. Those gaps often signal more fundamental shifts in sentiment or positioning. And as a result, those gaps tend to hold firm about 80% of the time. They don't fill.
Wow, it's the same pattern, completely opposite statistical outcome because of the market's DNA.
Precisely. Trading the S&P gap fade on your ESD is just throwing money away based on faulty assumptions.
So trying to trade 10 different markets at once means you're trying to learn 10 different DNAs simultaneously.
You're spreading yourself way too thin.
You basically guarantee you never build a real statistical edge in any single one. You just bleed out slowly through generalization.
That's the trap, which is why he recommends dedicating yourself to one market. Master it for, say, 6 to 12 months. Log at least 100 trades. Track its specific quirks, its personality.
Before you even think about adding a second market.
That's the professional approach.
Yeah.
Specialization first.
Yeah.
And once you've committed to that one ecosystem, you immediately move to rule number 2. Have a trading plan.
This isn't just jotting down a few ideas, is it? He's demanding a specific, written, tested blueprint. The whole point is to remove emotion.
Exactly. Why written? Because the second the market moves against you, and believe me, it will move against you.
Oh, yeah.
Your primal brain, your lizard brain just takes over. Fear kicks in, greed kicks in, hope, which is the worst strategist of all.
Right.
It clouds your judgment. A written plan is that commitment you made to yourself when you were calm, objective, analytical. It defined your edge before the pressure cooker environment of live trading.
He has that great line, a goal without a plan is just a wish.
And a plan without execution is just a document. It has to be actionable.
So let's detail the components. What absolutely has to be in this plan? It acts like a mandatory pre-trade checklist.
Absolutely mandatory. No checklist, no trade. He outlines 7 core components. First, the specific setup you're looking for, like a particular pattern on a higher time frame chart.
Okay. The
Context. Second, the precise entry trigger. This isn't vague. It might be hitting a specific price plus needing confirmation from volume, for example.
Got it.
Third, the non-negotiable stop-loss location.
Yeah.
And this has to be based on market structure, not just some random number of pips or dollars.
Where the trade idea is proven wrong.
Exactly. Fourth, your target, or even better, the specific method you'll use to trail your stop and let profits run. Fifth, the calculated position size. This isn't a guess. It must be determined by your stop-loss distance and that crucial 1% risk rule we'll talk more about. Sixth, your max daily loss. A hard stop for the day if things go sour protects you from revenge trading. And seventh, critically, the rigorous post-trade review process. Win or lose, you have to dissect it.
So just to be clear, if the setup looks perfect, but I haven't done the math on my position size based on where my stop needs to be.
You're violating the plan.
Rule 2 says, no plan, no trade, step back.
That is the discipline. That is the drill. The plan needs to be so specific, so mechanical, that you could almost hand it to someone else and they could execute it. No room for ambiguity.
So buy when momentum looks good is out.
That's subjective garbage. Useless. A good plan, using his 4x examples, might sound like buy a break of the 1.0850 level only if trading volume is greater than 1.5 times the 20-bar average. Place a stop loss 20 pips below the recent swing low at 1.0830. See the difference.
Crystal clear. Conditions aren't met, the trade is skipped. Discipline over gut feeling.
Every single time. Which flows perfectly into rule number 4. Know your time frame. This is about aligning the market's rhythm with your own life, your personality.
Yeah, this mismatch seems like a huge source of failure, the stress it creates.
It's a silent career killer.
Yeah.
Jankovsky really forces you to ask, what's my natural holding period? Does it actually fit my personality, my lifestyle, my available capital?
Give us an example of a bad mismatch.
Okay, say you have a demanding 9-to-5 job, right? But you're trying to scalp futures on a 5-minute chart. What happens?
You get pulled into a meeting right when you need to manage the trade.
Exactly. You're inevitably unavailable during that critical 15-minute window that decides whether the trade works or fails. You check your phone later, see it went bad, you panic, miss the exit, take a bigger loss. It's unavoidable stress.
Because what counts as a trend is completely different depending on your perspective, right?
Totally. A scalper, looking at a 5-minute chart, sees 15 minutes of sideways price action as an eternity of frustrating chop.
Right.
A position trader looking at a daily chart, that same 15 minutes is just meaningless noise within a larger uptrend. They don't even notice it.
So if you're naturally impatient, you'll probably hate position trading.
You'll drive yourself crazy. Yep. You'll be checking the charts constantly, second-guessing, probably overriding your logical, structurally based stop losses because you can't handle the normal ebb and flow.
And conversely, if you have limited capital,
you probably can't afford the wider stops and deeper drawdowns that are necessary for longer-term swing or position trading. Your account can't withstand the volatility. The time frame dictates the mental and financial capital required.
So if you violate this alignment rule, the stress alone just erodes your discipline.
Completely. It makes it virtually impossible to stick to the capital preservation rules, which are frankly even more important.
Okay, so if trading like a business is the foundation, then capital preservation, that's the absolute bedrock of survival.
It's everything.
In a zero-sum game, you simply have to stay solvent long enough for your edge, if you have one, to actually manifest. Which brings us straight to rule number 3. Think in terms of probabilities.
This is probably the biggest psychological hurdle for newcomers. You have to fundamentally shift your thinking away from certainty.
Ditch the idea that this trade has to work out.
Exactly. Get rid of has to. Trading is statistical. It's a numbers game. The outcome of any single trade, it's essentially random noise in the short term. What matters is your performance over a large sample size, 100 trades, 1,000 trades.
So the focus shifts from, am I right on this trade, to, does my system have a positive expectancy over the long run?
Precisely. You're focused on the long-term mathematical viability, which is defined by that term, expectancy.
Expectancy. That's the metric that actually validates whether you have a real edge worth trading. Can you walk us through the formula again and maybe illustrate why accepting losses is mathematically crucial?
Sure. The expectancy formula basically calculates the average amount you expect to win or lose for every dollar you risk over many trades. It's pretty straightforward. You take your win percentage, multiply it by your average win size.
Okay.
And then you subtract your loss percentage and multiply by your average loss size.
Win percent FG win, loss percent FG loss.
Correct. If that number comes out positive, you've got a mathematical edge. If it's negative or zero, you don't. And you need to go back to the drawing board.
Let's use a concrete example, because it's hard for people emotionally to accept that a system that loses more often than it wins can still make a lot of money.
It's counterintuitive but critical. Okay, imagine a trader. She's disciplined, follows her plan, but her system only wins 40% of the time.
Sounds pretty bad on the surface, losing 6 out of 10 trades.
Right. Most people would ditch that system immediately. But crucially, she adheres religiously to maximizing her winners. Her average winning trade, let's call it AVG win, makes her 3 times her initial risk, so 3R.
Okay, big winners.
But her average losing trade, because she cuts losses quickly, is exactly 1R her predefined risk amount.
Got it. 40% win rate at 3R, 60% loss rate at 1R.
Now let's plug that into the formula.
Okay.
40% win rate, 3.0R AVG win equals 1.2R.
Right.
Then 60% loss rate, 1.0R AVG loss equals 0.6R.
Okay.
Now subtract the loss part from the win part. 1.2R minus 0.6R equals
Positive 0.6R.
Positive 0.6R expectancy per trade. That means over 100 trades, she expects to net 60 times her initial risk unit, 100, 0.6R. She lost 60 times. But she still made significant money because the size of her winners vastly outweighed the frequency of her losers.
That math gives you the intellectual permission slip to take those 60 losses without freaking out.
Exactly. They're not failures. They're just the cost of doing business. The tuition you pay to capture those essential 3R wins. It shifts your mindset entirely.
From am I right to am I following the math? And the absolute first line of defense for protecting that math is baked into Rules 5 and 28. Define your risk.
Non-negotiable. This is the core survival principle. You risk no more than 1%, maybe 2% maximum of your total account capital on any single trade idea, period.
Adhering to this lets you survive the inevitable losing streaks.
It guarantees survival. Even professionals have streaks of 5, 7, 10 losses in a row. If you're risking 10% per trade, a streak like that wipes you out. If you're risking 1%, it's just a drawdown. You live to trade another day.
Let's revisit the math on recovery, the geometry of recovery, because this trips up so many traders. Why is that 1% threshold so powerful?
We have to revisit it. It's probably the single biggest reason accounts get blown up. Okay, let's use simple numbers. So you have a $100,000 account. Scenario 1. You follow the rule, risk 1% per trade, $1,000. You hit a nasty losing streak, 10 losses in a row. It happens. You're down 10% or $10,000. Your account is now $90,000.
Right. Painful, but not fatal.
Exactly. Now, to get back to your starting point of $100,000 from $90,000, what percentage gain do you need?
You need to make back 10K on a 90K base. That's about 11%.
Right. An 11% gain. That's achievable. Mentally, mathematically, it's within reach.
Okay. Scenario 2, the gambler.
Scenario 2, the guy who ignores the rule. He wants to hit a home run. He risks, say, 50% of the capital on one sure thing trade.
Oh, boy.
The trade goes wrong. he loses 50%. His $100,000 account is now $50,000. Now, what percentage gain does he need just to get back to break even, back to
He
$100,000?
needs to double his money. 100% gain.
A 100% gain. That is exponentially harder to achieve. The pressure is immense. Your judgment is probably shot. You're far more likely to take even more stupid risks trying to chase that massive target.
You're in the exponential danger zone.
Exactly. The 1% rule keeps you in the flat, linear recovery zone. It ensures survival. Risking big puts you on that vertical cliff face of needing huge percentage returns.
And that mathematical defense gets reinforced by the psychological filter in Rule 28, the one Jankovsky calls the sleep test.
Ah, the sleep test. This is like the trader's confession booth. It's simple. If the size of the position you have on, or even the potential loss you've defined as 1R, if it's causing you anxiety, if it's giving you knots in your stomach, if you feel this constant compulsion to check the price on your phone every 2 minutes,
then the position is too big.
it's already too big. You've broken the rule before the trade even plays out. You've risked capital that you mentally or emotionally cannot afford to lose without it impacting your stability or your lifestyle.
You've ceded emotional control to the market.
Which is the first step towards making catastrophic mistakes. If you can't sleep soundly with the position on, cut it down until you can.
So, okay, we've defined the risk mathematically, 1 to 2%, and emotionally, sleep test. The next critical step is the discipline to actually enforce it when the market tests you. Rule 7, honor thy stop. Jankovsky calls violating this a deadly sin.
It absolutely is. It's the precise moment a disciplined risk manager transforms into a hopeful gambler. Rule 7 is brutally simple. Never, ever move your stop loss further away from your entry price just because you hope the market will turn around.
Why is that so bad? Everyone feels that temptation.
Because when you initially place that stop loss, you are defining your maximum acceptable risk, your 1R, based on objective market structure and your expectancy calculations. The moment you move that stop wider,
You're just hoping.
you're throwing your entire risk management plan out the window. You've instantly converted a defined, statistically acceptable 1R loss into an undefined, potentially account-destroying loss. It's like moving the goalposts after the football game has already started because you don't like the score.
And because that hope, that urge to give it just a little more room is so powerful, he actually suggests enforcing a penalty on yourself if you violate this rule.
Yeah, the self-imposed penalty. It has to be painful enough psychologically to actually change your behavior next time. He suggests things like a mandatory 1-week trading ban if you widen a stop loss during a trade.
A whole week off.
Yeah, the pain of missing potentially profitable setups during that ban serves as a really powerful deterrent against letting hope override your rules again. The market itself doesn't punish hope immediately. Your discipline has to punish the violation of the plan. Honor the stop or step away.
And the logical consequence of honoring the stop is Rule 8. Take small losses. The psychological demons here are huge, right? Loss aversion, sunk cost fallacy.
Massive. That feeling of, well, I'm already down on this trade. Maybe I should just hold on a little longer. Maybe it'll come back.
Everyone feels that.
That feeling is the market whispering sweet nothings in your ear, leading you off a cliff. You have to reframe what that small loss represents.
How does Jankovsky suggest reframing it?
He stresses that the small loss, that 1R defined by your stop, isn't failure. It's tuition. It's the price you pay the market for a valuable piece of information. Maybe your setup wasn't as good as you thought. Maybe your timing was off. It's an investment in preserving your capital for the next high-probability trade.
Whereas a big loss.
A big loss isn't tuition. It's bankruptcy, emotionally and maybe financially. Exiting quickly at your planned 1R stop preserves the vast majority of your precious capital so you can deploy it when a truly great opportunity comes along. Don't defend a bad position.
And you mentioned a specific drill earlier, the loss celebration, which seems like a direct counter to that sunk cost fallacy.
Yes. This is a brilliant bit of cognitive reframing. The moment a trade hits your stop loss and closes you out, you immediately open your trade journal and you write down something specific like, I just paid $6 in tuition, the 1R loss amount, to successfully avoid a potential $10 catastrophic loss. This is a successful execution of my risk management plan.
So you're framing the loss as a win for your discipline.
Exactly. It forces your brain to associate the negative event, losing money, not with failure or stupidity, but with the positive outcome of adhering to your plan and ensuring your survival. You're rewarding the discipline, the 90%, which is always, always more important than the outcome of any single trade. You celebrate avoiding the disaster.
Right. This next section, I think, really turns the typical retail mindset completely upside down. Most people, especially in bull markets, default to optimism, right? They just assume markets are supposed to go up forever.
It's the default bias, yeah.
Yeah.
Hope springs eternal.
But Jankovsky hits this hard with rule number 24, which he considers absolutely essential. All markets are bearish by nature.
This rule is such a powerful antidote to confirmation bias, to herd mentality, to that dangerous optimism. The full statement he uses is profound, I think. Let me see if I remember it. A bull market is nothing more than a temporary imbalance in supply and demand.
Okay, temporary imbalance.
The natural state of any market is to go down until it can't go down anymore. It's like financial physics.
Let's unpack that physics. If a bull run is just temporary, what makes the downside the default, the natural state?
It really boils down to the effort involved. For a market to sustain an upward trend, what do you need?
Buyers. Lots of them.
You need sustained, aggressive, motivated buyers stepping up, putting fresh capital to work, hitting offers at progressively higher prices. It requires constant active buying pressure. Institutions have to keep absorbing any selling that comes in. Think of it like climbing a steep hill. You need continuous energy and forward momentum.
Okay, that makes sense. It takes work to go up.
Now think about the downside. What does it take for a market to fall?
Sellers. Or just nobody buying.
Exactly. It requires much less active effort. All you need is the absence of those motivated buyers. Or, even faster, a sudden wave of panic selling, maybe forced liquidation. The moment buyers step away, perhaps they hit their profit targets, maybe some bad news spooks them, the upward climb just stops.
And supply is always there.
Supply is effectively infinite. Anyone holding the asset can sell. Anyone can initiate a new short position. Demand, on the other hand, is finite. It requires both capital and conviction. And conviction can evaporate in an instant. So when that demand line breaks,
Gravity takes over?
gravity takes over. Prices can drop vertically, much faster than they ever climbed. Effortless falling versus effortful climbing.
So the bull market is the special condition, the exception that requires constant fuel. The bear move is just the market reverting to its natural gravity-influenced state when the fuel runs out.
That's the core idea. And internalizing this rule acts as a fundamental psychological shield against things like recency bias. Thinking, well, the S&P's been going up for 5 years, so it must keep going up.
Hope is not a strategy.
Hope is definitely not a strategy here. The professional mindset defaults to caution, always anticipating the potential for the downside to reassert itself.
Okay, so practically speaking, how should a trader actually incorporate this bearish by nature idea into their trading plan or execution?
Two main ways, really. The first is asymmetry in positioning.
Meaning?
Well, since downside moves tend to be sharper, faster, more violent, falling off that cliff,
Right.
you can often justify using slightly larger position sizes for short trades, but with correspondingly tighter stop losses. You aim to capture those quick, volatile moves, but your risk is very strictly defined.
Okay, bigger size, tighter stop for shorts. What about longs?
Conversely, for long positions, since they're essentially fighting gravity and require that sustained buying pressure to work,
The uphill climb.
it often makes sense to use slightly smaller position sizes, but give them wider stops based on market structure. You need to give the long trade more room to breathe during the inevitable noisy pullbacks so you don't get stopped out prematurely by normal volatility.
Smaller size, wider stop for longs. Makes sense.
Now,
What's the second application?
the second is how you approach setups. It dictates your default bias, especially on pullbacks or rallies.
Yeah.
Unless you have overwhelming, undeniable price action confirming strong demand.
Yeah.
Your default thought process should probably lean towards selling strength rather than buying weakness. Look for signs of rally exhaustion near resistance levels. Those setups, where demand seems to be drying up,
Are often higher probability.
they often are, because you're aligning yourself with the market's natural tendency, its gravitational pull downwards. You're betting on the fuel running out.
He gave that USD example from 2005 that really drove this point home. Can you tell that story again? It illustrates the effort difference perfectly.
Yeah, it's a classic anecdote about market physics. So back in 2005, the USD pair was in this long, grinding bull market. It took 15 long, slow, steady trading days
15 days.
of persistent, committed buying pressure to push the price up by 300 pips. Think about the sustained effort that required, a real uphill battle.
Okay.
And Jankovsky noticed near the top of that move, that volume was actually spiking, but the price itself wasn't really making much progress anymore. It was stalling out.
A sign of distribution.
Exactly.
Yeah.
That's often a sign of institutional distribution. The big players quietly selling their large, long positions into all that retail enthusiasm and buying pressure at the highs.
So he anticipated the turn.
He saw the signs, yeah.
Yeah.
He waited for the first clear lower high to form after the peak, and then he initiated a short position. Now, here's the punchline about the downside.
Okay.
When the demand finally broke, when the buyers stepped away, that subsequent bear move retraced 240 of those 300 pips.
How long did that take?
6 hours.
15 days to go up 300 pips, 6 hours to come down 240 pips.
See the asymmetry. The velocity of the drop was something like 25 times faster than the velocity of the climb. Why? Because the market returns to its natural state falling when demand disappears. And fear is a much more powerful immediate motivator than greed, so it accelerates that fall dramatically.
The lesson being?
If a market takes weeks climbing a wall of worry, it can fall down the cloud of fear in just hours or even minutes. Respect the asymmetry.
All right, we've got the foundation, the business mindset, the capital preservation rules, and this crucial bearish by nature psychological frame. Now let's get into the nitty-gritty of execution. How do we actually manage trades?
Right. Putting it all into practice.
And the starting point here has to be Rule 12. Trade with the trend. Jankovsky calls this non-negotiable physics.
It really is.
Yeah.
The trend is just the visible evidence of a sustained imbalance in order flow. If aggressive buyers are consistently overpowering aggressive sellers, the path of least resistance for price is upwards. It's that simple.
And trying to fight that.
Finding that sustained imbalance. That's like trying to swim upstream in a raging river. It's the definition of trading against probability. It's exhausting, and it's the fastest way to trigger all those psychological traps, fear, hope, panic that we talked about.
Your primary job then is just identify the trend and ride it.
Identify it correctly, and then ride it until the market structure explicitly tells you the imbalance has shifted. Not when you think it should shift, but when the price action confirms it.
Okay, so how does Jankovsky want us to define the trend? We need to go beyond just looking at a simple moving average, right? Those lag.
Exactly. He emphasizes structural analysis first and foremost, but then requires confirmation. So structure is simply the visual pattern. Are we seeing clearly defined higher highs and higher lows? That's a structural uptrend. Or are we seeing lower highs and lower lows? That's a structural downtrend.
Okay, the classic Dow theory definition.
Pretty much.
Yeah.
And this is key. You don't just jump in based on structure alone. You need to confirm that structure using his 3 filter system.
Ah, right. Let's detail that system again. What are the 3 filters that need to align before you commit to trading in the direction of the apparent trend?
Okay, filter 1 is price structure itself, the HHHL or LHLL pattern. Filter 2 is order flow, are aggressive buyers currently in control, or are aggressive sellers dominating the tape. You need tools to gauge this, like footprint charts or cumulative delta. Filter 3 is the volume confirming the price move. Is there conviction behind it?
So give me an example of a divergence, a warning sign.
All right, let's say price makes a new structural high. Filter 1 looks good. But your order flow analysis, filter 2, shows that on the last 2 pullbacks leading up to that high, aggressive selling was actually dominant. And volume, filter 3, on the new high itself is noticeably lower than previous highs.
That's a clear warning. Structure says up, but flow and conviction say maybe not.
Exactly. That's a critical divergence.
Yeah.
Jankovsky says you only take the trade with the apparent trend if at least 2 out of those 3 filters are clearly aligned in the same direction. Ideally, all 3.
That 2008 crude oil crash example he uses really highlights the power of just following the structure, right? Regardless of news or opinion.
Oh, it's a perfect case study. Crude oil had hit those insane highs above $140, completely unsustainable. Then it started making a very clear, undeniable series of lower highs and lower lows on the daily chart.
The structure turned bearish.
Unmistakably. Jankovsky, following his rules, initiated a short position around $92 after a rally failed and created another distinct lower high, confirmed by flow and volume. Now, did he cover his short when oil hit $60 and news headlines screamed, oil is cheap?
No, because the structure hadn't changed.
Exactly. He ignored the noise, ignored his own opinion about price, and just followed the structure. He kept trailing his stop loss above the previous lower high as the downtrend continued relentlessly.
All the way down.
All the way down. He only exited the core short position somewhere near $38 a barrel. Why that?
Because the structure finally broke.
Because the market structure finally printed the first confirmed higher high and higher low pattern in almost 4 months. That was the objective signal that the selling pressure had likely been absorbed and the trend might be changing. The lesson: follow the structure, not the news, not your gut feeling about how low it should go.
Okay, so follow the trend structure. That leads directly into how you actually manage the profits when you are in a winning trend trade. This addresses the other half of that old cliche letting winners run, rules 9 and 10.
Right. Rule 9 is basically let winners run, or as he puts it, the real money is made in the sitting, not the act of trading.
Why is that so hard for people? Why do we cut winners short?
Fear. Pure and simple fear that the paper profit you see on the screen is going to vanish if the market reverses even slightly. It's incredibly tempting to just grab that small profit now.
But statistically, that's a losing strategy.
It kills your expectancy. Remember that 0.6 R example? That trader needed those 3R wins to pay for all the 1R losses. Trading isn't about having a high win rate. It's about asymmetry. One single massive winner, a 10R or even a 20R trade, can often pay for an entire month or quarter's worth of small losses. Early exits destroy that potential.
So you need a system to mechanically overcome that fear.
Which brings us to Rule 10. Scale out. This is Jankovsky's specific engineered solution, his three-phase winner management system. And like the entry plan, it has to be executed mechanically without emotion.
Okay, break down the 3 phases. Phase 1.
Phase 1 is lock. The instant your trade moves in your favor by plus 1R, 1 times your initial risk amount, you immediately move your stop loss to your original entry price break-even.
Why is that first step so crucial psychologically?
Because it instantly removes the financial risk of the trade turning into a loser. You cannot lose money on the trade anymore, aside from maybe slippage or commissions. That eliminates the core fear of loss right there. The trade is now, mathematically speaking, risk-free.
Okay, the pressure comes off significantly. What's phase 2?
Phase 2 is scale. When the trade continues in your favor and reaches plus 2R, twice your initial risk, you take half of your position off the table, you close 50% of the trade right there.
What does that achieve?
2 things. First, it locks in a guaranteed profit equal to your initial 1R risk. That feels good psychologically. Second, it means the remaining 50% of your position is now effectively trading with house money. You've already banked a profit, so your emotional attachment to that remaining piece dramatically decreases.
You're less likely to panic out of the rest of it.
Much less likely. Which sets you up for Phase 3.
Phase 3, the ride.
Phase 3 is trail. Now, with the remaining 50% of your position, you switch to a dynamic trailing stop-loss strategy. You're no longer aiming for a fixed profit target. Instead, you trail your stock based on the market's actual behavior.
Like under the prior swing, low in an uptrend.
Exactly. Or maybe using a multiple of the average true range, ATR, to give it room based on volatility. The key is you're letting the market take you out of the trade when the trend structure actually breaks, not exiting based on a predetermined guess of where it might stop.
And this is how you capture those huge outlier moves.
This is it. This systematic approach is what could potentially allow a trader to ride a massive trend, like maybe catching Bitcoin at $13,000 and trailing the stop all the way up to $64,000, as in his example. If you had just taken profit early at, say, $18,000 because you got nervous.
You missed the lion's share of the move.
You captured maybe a 3R or 4R win, which is nice, but trailing the structure could have yielded a 10R, 20R, or even larger win, the kind of win that truly makes a difference to your long-term equity curve. The system forces patience by removing fear and locking in gains incrementally.
Okay, so we're in a trade, it's moving our way, the stop is at break even or better, now we have to deal with the mental noise of just watching it. Rule 14, don't second guess.
Oh, this is a big one. Doubt truly is the profit killer. Once the trade is active, your stop is protecting you, ideally at break even or in profit thanks to phase 1, and the plan is technically working. Your job as the trader is essentially done for the moment.
Until the next management point is hit.
Right, until price reaches your plus 2R target for scaling out or triggers your trailing stop. Constantly staring at the screen, watching every little tick up and down, that's counterproductive.
Why? What does screen staring lead to?
It leads to overmanagement. You start seeing patterns that aren't really there. You mistake normal, healthy pullbacks within the trend for major reversals. You get antsy, you override your plan, and you snatch a small profit or exit prematurely just because you got spooked by noise.
So what's the antidote? The hands-off rule.
Yeah, he strongly recommends it. Once your trade is risk-free, stop at BE. Set price alerts for your next management levels, plus 2R trailing stop levels. Then, close the charting platform. Walk away. Go do something else. Trust the process. Trust the plan you made when you were objective and calm. Don't babysit.
Easier said than done, but crucial. And the final piece of this execution puzzle is Rule 16. Participate, don't predict. This seems aimed squarely at the ego.
It absolutely is. Prediction is an ego trap, especially for smart people who think they can outwit the market. Amateur analysts make predictions. It's how they get attention or sell newsletters.
But professionals.
Professional traders are reactors, not predictors. They are followers of what the market is actually doing. The market doesn't care about your brilliant analysis of why Tesla should go up, or your insightful prediction about the Fed's next move.
It only pays for execution based on what is happening.
Precisely. It only rewards those who react decisively to confirmed price action. Wait for the breakout to actually happen and hold. Wait for the lower high to clearly form and be defended. Wait for the volume to come in and confirm the move. Then you participate. Don't jump the gun based on what you think or hope the market will do next.
Ego wants to be first and predict. Profitability requires patience and reaction.
You got it. Let the market tip its hand, then place your bet accordingly.
Okay, moving into the final stretch here. We need some more advanced tools now, the ones that help us filter out the noise and, crucially, spot potential traps set by institutional players.
Right, refining the edge.
To execute properly, we need to sync up different perspectives. This brings in Rule 11. Exploit multiple time frames, and Rule 13. Focus on price action. Let's start with Rule 11, the time frame triangle.
The Kiev triangle is fundamental for ensuring you're not making small decisions that go directly against the bigger picture, the dominant flow. It prevents you from, trying to pick bottoms in a raging downtrend.
Just how does it work? Higher, middle, lower frames.
Exactly. You use the highest time frame, you track maybe the daily or the weekly chart to determine the dominant trend direction. That direction is your gospel. You simply do not fight the tide established on that higher frame.
Rule number 1, don't fight the primary trend.
Pretty much. Then you drop down to a middle time frame, say the 1 hour or the 4 hour chart. This is where you look for your setup.
Yeah.
You're looking for the trend on the higher frame to pause, consolidate, or pull back to a key support or resistance level within that larger trend.
Okay, context from the high frame, setup on the middle frame, then the entry.
Then you drop down one more level to your lowest time frame, maybe the 5-minute or 15-minute chart. This is where you look for your precise surgical entry trigger, a specific candle pattern, a break of a micro level, confirmation by immediate order flow, whatever your plan specifies.
So let's say my 1 hour chart shows a beautiful consolidation pattern, looks like a perfect buy setup. But I glance up at the daily chart, and it's clearly making a series of lower highs and lower lows, a strong downtrend.
Then you skip the 1 hour buy setup, period, no matter how good it looks in isolation.
Why does the higher time frame get the ultimate veto?
Because it reflects the commitment of larger amounts of capital over longer periods. It shows where the deeper institutional money flow is likely heading. If you're buying on the 15-minute chart based on a temporary uptick, but the daily chart is screaming sell, you are essentially choosing to step in front of a potential freight train of institutional selling pressure.
You're fighting the river again.
You're fighting the river. Always align your trades with the direction of the highest relevant time frame.
Okay, that makes sense. Now, Rule 13 tells us what to focus on within that multi-frame structure. Focus on price action, not news, not opinions.
Right. Price action is the ultimate truth teller. Everything else is just noise, commentary, or potentially manipulation. Retail traders get so easily sidetracked by headlines, Fed announcements, earnings reports, geopolitical drama.
Yeah, constantly reacting to the news feed.
Professionals, or at least disciplined traders, learn to filter that out and focus only on how the market actually reacts to that news. What is the resulting order flow telling us? Did that supposedly good news actually generate aggressive buying that broke resistance on high volume?
Or did the market shrug it off, or worse, sell into the rally?
Exactly. The price movement itself, the structure of the candlesticks, the volume profile that forms, that is the collective, aggregated, quantifiable vote of every single market participant, from the smallest retail trader to the biggest hedge fund. That's the reality. Ignore the narrative. Read the tape.
Okay, read the tape. Now let's get into a really powerful tape reading tool, especially vital for futures and commodities traders, but relevant conceptually everywhere. Rule 17, manage open interest, OI, and volume. This is where we spot the institutional footprint, right? The potential lies.
This is classic floor trader wisdom adapted for the screen. Think of it like this. Price is the puppet. Volume and open interest are the strings that reveal who is actually pulling and how committed they are.
Okay, explain the difference again. Volume is.
Volume tells you the intensity of activity right now. How many shares or contracts traded in this bar? It measures conviction, aggression, urgency in the current moment.
And open interest, OI, that's different.
Open interest is a measure of commitment. It's the total number of outstanding futures or options contracts that haven't yet been closed out, offset, or fulfilled. OI tells you whether new money is flowing into the market, OI rising, or if existing positions are being closed out, OI falling. It reflects the overall level of participation and conviction over time.
So how does looking at the relationship between price, volume, and OI help us spot traps or lies?
The most common and dangerous trap it reveals is the weak bull trend, often called a bull trap, built on shaky foundations. Let's say you see price grinding higher, maybe even making a new high for the move. And volume might even be pretty high on that push. Superficially, it looks bullish, right?
Yeah, price up, volume up. Looks good.
But then you look at open interest and you see that OI is actually falling, or maybe just flat, during that price rise. What does that divergence tell you?
New money isn't coming in to support the higher prices.
Exactly. It means the upward price movement isn't being fueled by enthusiastic large new buyers establishing fresh long positions. Instead, the buying pressure is likely coming from existing short sellers who are being forced to cover their losing positions. That short covering creates temporary demand, pushing prices up.
While the smart money might be...
While the institutional smart money, seeing this lack of new committed buying, might be using that short covering rally as the perfect opportunity to quietly distribute, to sell their own long positions into that artificial strength before the move exhausts itself.
So, falling OI while price is rising is a major red flag. The rally is running on fumes.
It's a huge warning sign of exhaustion and potential institutional distribution. The classic textbook example was that crude oil topped back in July 2008. Crude screamed up to $145 a barrel. The news was all bullish, looked like it was going to $200.
I remember that mania.
But traders like Jankovsky, who were watching the internals, saw that open interest had actually started to decline significantly before price made its ultimate peak. Price was still inching higher, but the actual institutional commitment, the new money flow, was leaving the market. Massive divergence.
Smart money was getting out.
They were liquidating their longs into the final frenzy. That OI divergence was arguably the single most objective, reliable sell signal at the top. A few weeks later, oil began its historic crash. Ignoring OI in that context meant you completely missed the setup for one of the biggest trades of the decade.
Wow, okay, powerful stuff. Let's move to another structural tool, Rule 18. Use Fibonacci for objectives. You mentioned earlier these aren't magic numbers, but more like a map of collective psychology. How does Jankovsky suggest using them effectively?
Right. They work primarily because so many people believe they work and place orders around them. They become self-fulfilling areas where liquidity tends to pool. Stops get clustered just beyond key fib levels like 38.2%, 50%, 61.8% retracements, and profit targets often get set at extension levels like 161.8%, 261.8%.
So smart money knows this and targets these zones.
Absolutely. They hunt the stops and fade the targets. Jankovsky often mentioned using the 61.8% retracement level, sometimes called the golden ratio or golden zone, as a potential area for trade entries during pullbacks in a strong trend. Why? Because it often represents the deepest pullback that can still be considered healthy before the primary trend resumes.
And for targets.
He often looked at the 161.8% Fibonacci extension level, measured from the prior swing, as a logical minimum target for a trending move to reach.
And this seems crucial, he insists they don't work in isolation, right? The need for confluence.
Absolutely critical caveat.
Right.
A naked Fibonacci level floating in the middle of nowhere on a chart is practically worthless. It only becomes a high probability tool when it converges with other significant technical factors.
Like what?
Like, does that 61.8% retracement level also line up perfectly with a major prior support or resistance zone from weeks ago? Does it coincide with a key moving average that the market has been respecting? Is there a high-volume node from a volume profile study sitting right at that level? Are you seeing candlestick patterns confirming a reaction right at that confluence zone?
So you need multiple reasons for price to react there.
Yes. When you get that confluence, maybe a fib level, plus old support, plus the 50-day moving average, plus a bullish engulfing candle all lining up in the same spot, that's when a Fibonacci level transforms from random geometry into a potentially powerful high-probability setup area. You're stacking the odds in your favor.
Combining geometry, history, and current flow.
Got it. Okay, final section.
Yeah.
The personal systems. These are designed to protect the trader from their worst enemy.
Themselves.
Right. Rule 20. Journal every trade, and Rule 21, avoid revenge trading. Let's start with the journal. The trading journal is your performance autopsy tool. It is not a diary for venting your feelings, although understanding your psychology is part of it. Its main purpose is rigorous, objective analysis. If you don't systematically examine your past trades, both winners and losers, you're absolutely doomed to repeat the same mistakes over and over again.
What specific things does Jankovsky say must be in the journal entry for each trade?
He demands at least 5 key fields. 1, the setup. Was it a high-quality A+ setup according to your plan, or were you forcing it? 2. Execution. Did you follow your plan perfectly for entry, stop loss, and trade management, or did you deviate? 3. Outcome. The objective result, usually measured in R multiples. How many times your initial risk did you win or lose? 4. Psychology. What were you feeling before, during, and after the trade? Fear, greed, impatience, confidence. And 5. The lesson. What is the single biggest takeaway or actionable insight from this trade?
The unexamined trade is the repeated mistake.
Exactly. The journal forces you to confront reality. It helps you identify the patterns in your failures. And spoiler alert, the pattern is almost always psychological. You'll see things like, I violated Rule 7, honor thy stop, 3 times this week when trades went against me, or I consistently jump into trades too early before getting confirmation. The journal reveals the leaks in your process.
And spotting those leaks leads directly to Rule 21, which is the emergency procedure for when those psychological leaks cause damage. Avoid revenge trading.
This is the immediate circuit breaker needed after a loss, or especially after a series of losses, or even after making a stupid mistake like violating a rule. The impulse is incredibly strong.
To jump right back in and make the money back. Instantly.
That immediate visceral urge to get revenge on the market for taking your money. That is revenge trading. And Jankovsky is blunt. Revenge trading is guaranteed bankruptcy, just on a faster timeline. Why?
Because you're emotional, not rational.
Your judgment is completely clouded. You're likely to oversize your position dramatically. I get all back on this one. You'll probably ignore your setup rules entirely, chasing anything that moves. One single impulsive, oversized revenge trade can easily wipe out the profits from weeks or even months of disciplined, patient trading.
So what's the mandatory procedure? The 30-minute rule?
Yes. After any loss, but especially a significant one or one caused by a mistake, you institute the 30-minute rule. Mandatory. Step away from the screens completely. Get up. Leave the room. Go for a walk. Clear your head. Do not look at charts. Do not think about the next trade. You need to break that emotional feedback loop.
Let the adrenaline subside.
Let it subside. Refuse the impulse. Then when you do come back, what do?
Perform the loss analysis in the journal.
Yes. Pay the tuition, do the loss celebration, reframing if it helps, understand why it failed, and then, critically, you consciously reset your risk for the next trade back to your standard 1%, no doubling down.
Yeah.
And you wait patiently for the next valid, confirmed, A+ setup according to your plan. No exceptions.
Discipline over emotion. Always. Which brings us to the ultimate safety net, the final filter for long-term survival. Rule 19, equity curve trading. This isn't about individual trades. It's about managing the account itself. Hard stop loss on your career.
This is the mark of a true professional, thinking about long-term capital preservation above all else. You have to treat your trading account equity curve as your ultimate boss. It tells you objectively how well you're performing. Equity curve trading means you institute a hard, predetermined drawdown limit on your overall account balance.
What kind of limit does Jankovsky suggest?
He often suggested a maximum drawdown of around 10% from the most recent peak equity high in your account.
So if my account hits a new high of $110,000, my hard stop level becomes $99,000, 10% down.
Correct. And if your account equity then drops and hits that $99,000 level, what do?
You stop trading live money immediately.
Immediately. Pause all live trading. Close out any remaining open positions. No ifs, ands, or buts. No, maybe just one more trade to get back above it.
Okay.
Why is hitting that 10% drawdown level such a critical line in the sand? And what are you supposed to do during that mandatory pause?
10% seems to be a common psychological threshold.
Mm-hmm.
Below that, drawdowns often feel like manageable statistical noise. But once you cross that 10% loss mark from your peak, the psychological pressure tends to ramp up dramatically.
You start feeling desperate.
Many people do. They start feeling the need to get back to even quickly, which leads to
Revenge trading, oversized bets, ignoring rules.
all the bad stuff. Compounding the drawdown. The mandatory pause forces an objective intervention before you spiral. During the pause, your job is to go back to your journal with a magnifying glass. Find the leak. What caused the drawdown? Was it poor market conditions? Or more likely, was it your execution? Were you consistently violating Rule 7? Were you trading setups that didn't meet your criteria? Were you fighting the higher time frame trend? Rule 11.
Bring the root cause.
Find the root cause of the bleeding. Once you think you've identified it and have a plan to fix it, you don't just jump back into live trading.
What then? Demo trading.
You switch to demo trading or paper trading, and you stay there until you can prove objectively, with a track record in the demo account, that you have plugged the leak and restored consistent profitability according to your rules. Maybe that means achieving a 5% gain on the virtual account while adhering strictly to every single rule.
So it's not just about the money, it's about proving you've regained control and discipline.
Exactly. The pause isn't just mathematical damage control. It's a required emotional and procedural circuit breaker. It prevents a bad week or a bad month from cascading into a career-ending disaster. It forces self-reflection and correction before you hit total ruin. It's the ultimate professional survival mechanism. #outrecho.
Wow. Okay, so going through all 28 of these essential rules from Jason Alan Jankovsky in this deep dive, it really hammers home his core argument, doesn't it? Longevity in this game isn't really about finding some magic indicator or a perfect predictive algorithm.
Not at all. It's almost entirely about perfecting self-management, self-discipline.
The rules themselves, when you list them out like this, they seem like simple truths, almost common sense in retrospect. Cut losses, follow trends, manage risk.
Right. They're not conceptually complex. But the consistency in applying them day in and day out under pressure, that's the master key. That's the 90%.
So the core philosophy really boils down to survival first.
Survival above all else. And that survival is achieved through disciplined, mechanical execution of a plan that needs to be statistically validated, have a positive expectancy.
And all underpinned by ruthless emotional control, like a pilot running through checklists.
Exactly. The market isn't looking for genius IQs. It's actively hunting for participants with low discipline. It rewards the disciplined, and it takes money from the impulsive, period.
It really circles back to that stark, brutal reminder he gives. Trading is a zero-sum game, or near zero-sum after costs.
Which means, as he puts it so bluntly, you have to be the predator or you are the prey.
There's really no comfortable middle ground in the long run, and the level of discipline you bring consistently determines which role you ultimately play.
And make no mistake, the market will test every single one of these rules within you, especially the hard ones like Rule 7, honor thy stop, Rule 10, scale outlet winners run, and Rule 21, avoid revenge trading. It will use temptation, fear, and greed to try and break your discipline every single day.
Your ability to survive and thrive over the next 5 years probably depends almost entirely on how you handle the emotional pressures of the next 48 hours of trading.
That's a sobering thought, but likely true. It's a constant battle against yourself.
So, if we accept Jankovsky's premise that trading success is 90% psychology, here's our final provocative thought for you, the listener, to really chew on as you head into your next trading session. It focuses squarely on that crucial 90%.
What specific, concrete, measurable daily ritual, think of it as a psychological circuit breaker or reinforcement tool, will you implement starting tomorrow to actively ensure you trade your plan, not your fleeting feelings?
Will you literally print out your trading plan checklist and physically sign an oath of adherence every single morning before you're allowed to log into your platform?
Will you commit absolutely to performing that loss celebration journaling exercise immediately after every single stopped out trade, forcing that positive cognitive link to discipline?
Or will you rigorously implement the hands-off ritual, closing the charts, setting alerts, walking away the very instant your stop loss hits break even on a trade?
Because that daily ritual, whatever you choose, that's the tangible action you take to manage the 90%. That's the habit that protects your fragile 10% statistical edge from your own human nature.